Something that was never taught to me at a young age was the importance of your credit. I totally screwed this up when I was younger, and I don't want you to make the same mistakes I did. In today's video, I'm going to talk to you about your credit, what goes into your credit score, and help you understand how critical your credit history is. Check it out. So you're ready to go out and buy a new car. You head out to the dealership, find one you love, fall in love with it, and you know you just can't leave the dealership without it. You're going to have to take out a loan in order to do it, and the salesperson is saying they're offering special interest rates, so after you work out a few details, you make your way into the finance box and talk to somebody else. And the dude there says, well, let's run your credit and set you up with financing, only to have him come back and say, sorry, credit score is just way too low. Denied. You then have to take the walk of shame out of the dealership and head home and rethink your life. And you're wondering, what is a credit score and why is it so low? I make all my payments. Growing up, I watched my family members become chained to the almighty credit card. And then they got in so much debt, they struggled to make payments, they were getting denied for loans, even mortgages. You think I'd learn from someone else's mistakes? Nope. I grew up doing the exact same thing and got myself in a bit of a bind. I had some really tough years and had to figure out how to combat all of this on my own. I pulled through though and learned quite a few things along the way that I want to share with you. Financial institutions or lenders are basically banks that will lend you money. They use your credit score to see if they can take a risk on you. After they review your credit, they may determine that you're a lower risk, so they would give you a lower interest rate. If you're a higher risk because you don't have that great of credit, they're going to give you a higher interest rate. You may not think that's a big deal, but let's take a quick look at a loan calculator to see how the interest rate can impact your payment. So I'm here at a website, bankrate.com, and I'm using their loan calculator. Okay, let's go in and do a mortgage now. Let's say you want to buy a house for $300,000 for a 30-year term, and we're going to do 6% interest on your mortgage. Hit the calculate button. We're looking at a monthly payment of just under $1,800, and the total interest paid is going to be almost $350,000. That's for the life of the loan over 30 years. You're paying more interest over the 30-year time than the loan itself. Okay, keep that in mind. Now, this is just the principal and interest. This is not accounting for any escrow or insurance and taxes and things like that. We're just looking at principal and interest. Now, let's say you don't have the best credit and we're going to jump your interest rate up to, let's say, 10%. That's just up 4 points. And hit the calculate button. Just remember, we're at just under $1,800 a month. Boom, look at that. It jumps up to $2,632. Total interest paid is almost $650,000. That is just 4 points. A 4-point change in your interest rate on a mortgage will cause that significant change. This is something that is very serious. It's not taught, and you need to pay attention to your credit so you can get the best rate possible. Your credit score is absolutely critical. So what is it? The Fair Isaac Corporation, or more commonly FICO, has developed a baseline method by reviewing weighted factors that are associated with your credit history to determine your credit score that will fall within a range between 300 and 850. A good range to be in is anywhere from 670 to 739. There's going to be a time when you want to buy that dream car or family car, maybe even your dream home, only to get denied by the lender, or you're in a position where you have to say no because the payment came in too high. Your dreams are smashed all because your credit score doesn't meet the requirement. This is so defeating, but if you understand what governs your score, you can combat this and become financially healthy so you never have to worry about it. Before we can talk about improving and managing your score, we have to talk about where your credit score comes from and how financial institutions use it to approve your loan or grant you a really good interest rate. There are 3 credit bureaus that track your credit history, and they use this information to develop your score. The 3 bureaus are Experian, TransUnion, and Equifax. Each of these 3 bureaus has a credit history on you. Every time you apply for a loan, every time you apply for a credit card, it's tracked. Your balances on all your accounts are tracked. All of your late payments are tracked. Debts you forgot you had and never even paid are tracked. Debts that went to collections are tracked. Bankruptcies are tracked. Safe to say that pretty much anything associated with a loan or credit card is tracked. And it's up to you to make sure they are tracking correctly so that they give you the best score. What's on your credit report is what makes up your credit score, and this is what financial institutions use to see if you qualify for any kind of loan or credit account. If you're in a rough situation and need to rebuild your credit, you first need to understand what impacts your score. The first thing you need to do is review your credit report from all 3 bureaus. You are entitled to a free credit report once every 12 months. And you can go to annualcreditreport.com and request your credit reports from all 3 bureaus. It's going to give you a history of all the accounts you've ever had along with your payment history. You'll be able to review the information on each report for accuracy. If there's something incorrect, like an account you're certain you've never opened, you can reach out to that particular bureau and dispute it and request that it be removed. According to FICO, the thing that has the highest impact to your score is your payment history. This accounts for 35% of your score. Things like making your payments on time, how many times you're late, how many different accounts you are late on, how many payments do you have to make. Lenders use this information to see if they can take a chance on you making the payments to what you're applying for. Why would they lend you money if there's a chance that they're not going to get it back? You're not going to be able to make the payment. If you're making payments on time, great, keep it up. If not, you may need to consider a different strategy to your personal finances. The first video in this series covers this, and here's a link above. If you need help with paying down debt, I'll talk about a debt paydown strategy that worked really well for me, and it also helped me increase my score. More on that in just a little bit. Coming in second place with another high impact at about 30% are the amounts owed on all your accounts. What they're going to do is compare all of your amounts that you still owe and bounce that off of your credit limit. How much available credit do you have? Are your accounts all maxed out? That's going to negatively impact your score. The target for a positive impact is 30%. That means don't carry a balance on any of your accounts higher than 30% of your limit. Let me simplify it a little bit. If you have a $30,000 credit limit on a credit card, your balance should be no more than $9,000. If you can pay down your balances to be about 30% or less of your credit limit, your score will greatly improve. Closing out accounts can hurt your score because it removes available credit for that calculation. If I've paid down credit cards and I still have high balances on others, and I go, well, let me just close them so I never use them again, there goes that calculation. They don't have that available credit to bounce off your amount owed. Be mindful of this if you're trying to rebuild your credit. This is also something the lenders will dive into. They call it a debt-to-income ratio. Whenever you apply for a loan or a credit account, you have to provide your income and sometimes how long you've been working with your current employer. What they're doing is comparing how much you have to pay out every month and bouncing that off how much you're earning. If there's plenty of money left over to make this payment that you're applying for, you're more likely to get approved. Be mindful of your debt-to-income ratio if you're wanting to make a major purchase like a car or home in the near future. The next thing that impacts your score is your credit history. This will account for about 15% of your score, and it's just kind of difficult to work on as it's pretty much an account over a period of time. There's not much you can do except continue to work through and maintain your accounts over time to increase your score and build a clean credit history. The longer you have an account with payments made on time and a good history, the more positive impact this will have on your score. Something else that impacts your score are the types of accounts that you have. This has a low impact, and I'm only talking about 10%, but it's still something to be aware of. If you have nothing but store credit accounts like department stores, electronic stores, and I'm talking about like non-major credit cards, this can negatively impact your credit score. What they like to see is a mix of installment accounts and revolving accounts. Installment accounts are like car loans and mortgages. Revolving accounts are like your credit cards, major credit cards and store cards. They call them revolving because the balance can fluctuate over time. Now, this does have a low impact, but an impact nonetheless, and it should be looked at. If you're trying to rebuild your credit or just starting to develop a credit history, a store account may be your only option. These accounts are usually easy to get approved for and a good option to start building a credit history or to get back into rebuilding your credit. And finally, new credit or recent activity on your credit report. This also has a low impact, just about 10%, but it's basically having your credit pulled for applications for new accounts. So if you're going to a store and opening accounts left and right, you're going from one department store to another, you're running over to a car dealership and applying for a car loan, and then opening up a major credit card or two, your score's going to take a hit. So the next time you're in line at that store and they're like, want to save 10% by opening up an account? Think about it. Probably should say no. That could impact your score. I can't tell you how bad I want to go back in time and change the way I manage my money. I wish I knew all this stuff. If I had managed my finances better, I'd be in such a better place today. If you're in a situation where you can't seem to get ahead of your debts, here is the strategy that worked for me. It's called the debt snowball method. Traditionally, you pay the minimum payments on all your accounts, except for the one with the smallest balance. The account with the smallest balance, you pay as much as you can. Hopefully, it's well above that minimum payment. You pay as much as you can every month until that account is paid off. After it's paid off, you take everything that you were paying and add it to the minimum payment of the remaining account with the lowest balance. Continue this trend, and when you get to your last account, you'll finally have a large payment being applied each month, causing this final account to be paid back fast. Now, this only works if you are committed to not using your credit cards anymore. Otherwise, the accounts that you're paying the minimum payment on are going to get out of control fast. I did this method, but a little different. I worked the snowball method, but I didn't start with the account with the lowest balance. I looked at the interest being applied to each account along with the minimum payment and calculated which account would benefit the most by the extra payment. I'm basically trying to get the biggest bang for my buck. In other words, if I had two accounts with the same balance, but one had a lower interest rate, I'd focus on that one because the principal would get paid down faster each month. My payment would go further and have a greater impact to my overall balance of debt. Paying the higher interest accounts first would take longer to get things moving, and that just hurt my mental health. I needed to see progress. It motivated me. It drove me. It kept me going. Some people focused on the smallest balance because they'll get that paid off the fastest. Some believe that secured debts should be paid first. A secured debt is a debt that has something attached to it as collateral, like a car, a house, a car loan, where your car is securing the debt. If you don't pay the bill, they'll come take your car. At the end of the day, all of your bills need to be paid, and you just need to get the ball moving, but moving in the right direction. You need to do what's best for you and what works for you. If you have a different debt pay down strategy, drop it in the comments below. I like to read all about this kind of stuff. Also, be sure to subscribe as I'm already working on the third and final part of this short series, Basic Investing. Now that you've paid down your debts, you've got some financial relief, it's time to make your money work for you. I hope this video helped you out and motivates you to get your personal finances on track. If it did, please drop me a thumb. It's a great feeling when you can get rid of some stress and latch on to that sense of accomplishment. Just keep going and hang in there. I'm the Capable Gentleman, showing you ways to go from dirty to dapper and to encourage you to never stop learning. Until next time, be kind, everyone. See you next week.